The richest people I met are quietly doing something most middle-class people would never consider. They're refusing car payments completely, not delaying them, not negotiating them, just avoiding them entirely. And the strange part is, they're not buying cheaper cars either. They're changing how they think about ownership itself. At first, I assumed this was just personal preference, but the more people I spoke to, the more it looked like a pattern. High earners, business owners, early retirees, all quietly moving away from something that 90% of working people accept without question: car payments. And I needed to understand why. A few months ago, I met a financial consultant who works with high net worth clients across Dubai and London. He didn't talk like a salesman or an influencer. He talked like someone who sees patterns most people miss. We'll call him Daniel. And the first thing he said didn't sound like finance advice. It sounded like a warning. Most people think they are buying cars, but they're actually buying monthly pressure. That sentence didn't make sense at first, so I asked him to explain. He opened something on his laptop that changed the direction of the entire conversation. A $40,000 car. Most people look at one number: monthly installment. But Daniel broke it into layers most buyers never mentally calculate: depreciation, interest, insurance, maintenance, fuel, registration. And suddenly the affordable payment wasn't affordable anymore. But the real shock wasn't the cost, it was the structure. Because even when the car loses value, the payment does not. It stays exactly the same. And that imbalance is where financial pressure quietly builds. Then Daniel said something that reframed everything. In wealth psychology, there is a difference between owning something and financing your life around it. Most people don't realize they are not choosing cars. They are choosing commitments to their future income. That's when I started seeing a pattern, not just in one country, not just in one income group, but across almost every middle-income economy. People upgrade cars every 4 to 6 years. A new loan replaces the old one. A higher payment replaces the previous one. A newer model replaces the last. Symbol of progress. On paper, it looks like growth, but financially, something else is happening. They are not moving forward. They are cycling through debt structures. And that cycle rarely breaks. To verify this, I spoke to someone who used to work inside the system. A former auto financing manager from a large dealership network. We'll call him Ryan. And he said something surprisingly honest. Most customers don't ask the real price of the car. They ask what monthly payment they can manage. That one shift changes everything. Because once the focus becomes monthly affordability, total cost disappears from the decision. He also revealed something more interesting. Longer loan terms are now normal. 6 years, sometimes even 7 years. On the surface, it looks like financial flexibility, but in reality, it extends financial dependency. You are still paying for something you stopped benefiting from years ago, and the system keeps it smooth enough that most people never feel trapped. But here's where the investigation got uncomfortable. Because none of this is accidental, modern car systems are designed around financing behavior, not ownership behavior. Everything is structured to make expensive decisions feel small monthly. And psychologically, humans always choose smaller pain over visible large cost. That's why it works. Then Daniel gave me a line that stayed with me. If your lifestyle requires monthly payments to maintain it, you don't fully own your lifestyle. That includes cars and much more than cars. Because once you see it, you start noticing it everywhere. Subscriptions, loans, MS, leases. Modern life is increasingly built on recurring financial commitments, and cars are one of the biggest of them. But the deeper issue is not math, it's behavior. Because when people feel financially stable, they don't reduce obligations, they expand them. A better car, a newer model, a higher status symbol. Not because they need it, but because income growth creates psychological permission to upgrade lifestyle. This is where another financial planner added something unexpected. The higher someone earns, the higher their fixed payments usually become. Not always, but often enough to matter, because income grows faster than financial discipline. And that gap is where long-term pressure is created. At this point, I started noticing something important. The people who feel financially free are not always the highest earners. They are the ones with the lowest fixed obligations, fewer monthly commitments, more optionality, more control over future decisions. And that word kept coming up again and again. Optionality, because in unstable economies, flexibility is more valuable than appearance. You can survive uncertainty if your monthly obligations are low, but you cannot easily survive it if your lifestyle is locked into fixed payments. Then Daniel reframed the entire idea in one sentence. Debt is not just borrowing money, it is borrowing pressure from your future self. And car payments are one of the most normalized forms of that pressure. But this is not a cars are bad argument. Cars are necessary. They create mobility, opportunity, and efficiency. The issue is not ownership, it is structure. Are you controlling your transportation cost, or is your transportation cost controlling your financial life? Because in the investigation, one pattern became clear. Financially calm people were not avoiding cars, they were avoiding overcommitment. They were choosing systems that don't lock future income. And that changes everything, because in a world where uncertainty is increasing, fixed obligations become more dangerous than one-time expenses. Then Daniel said something that summarized the entire shift happening quietly. Smart people aren't avoiding cars. They are avoiding anything that reduces their freedom to adapt. And that reframes the entire discussion, because the real question is not, can I afford this car? The real question is, what am I giving up in the future because of this payment today? Before I left, he added one final thought. The system doesn't punish people for buying cars. It rewards people who don't overcommit to them. And that's the part most people never notice. Because financial pressure doesn't rise suddenly, it builds quietly, month after month, payment after payment, until it feels normal. And maybe that's the real story here, not cars, not payments, but how easily long-term financial pressure can disguise itself as normal life. And by the time people recognize it, they are already inside it.